Good afternoon, everybody. Thank you for joining us for this special webinar on everything to do with moving from these to these regions. Everyone knows there are different things that you're going to have to navigate, and that's why I brought through these three great speakers from all different sides of the investment realm. Guys, feel free to introduce yourself. Let's start with Jonathan.
Great. Yeah, thanks for having me, Isabel and Anthony, and good to see you, John. Quick intro on me. I'm one of the co-founders of Mountside Ventures. Our sole mission is to optimize the funding process for startups and investors. So we support the most ambitious tech entrepreneurs in raising institutional funding, and we also support funds on their own fundraisers from limited partners and family offices.
Anthony, over to you.
Hello, I'm Anthony. I'm founder and CEO at SeedLegals, the largest closer of funding rounds in the UK. Most of our companies are an angel/seed. One of the wonderful things on SeedLegals is once people start on our platform, they tend to stay with us. So for me, this is really fascinating. We've been in business 3.5 years, and we've seen a growing number of companies who've done their initial friends and family, then angel, then seed round, and now moving on to Series A. And we see a similar pattern, and I thought I'd share our insights on that to help you.
John, over to you.
Thank you, Isabella. John Courtney. I'm founder and CEO of Boardroom Advisors. We provide board advice as part-time executive and non-executive directors, including part-time managing directors, ops directors, and so on, and to funded startups, scale-ups, and SMEs. And so obviously I bring the advisor angle to all this.
Okay, cool. So just as a recap to everyone, a little bit of housekeeping. If you want to introduce yourselves, what your company does, feel free to do that within the chat. Next to that, you have questions. It's best to put them in there because it's just more visible to us. We're going to cover 5 key things. And then in between that and everybody adding their point of view, feel free to ask questions. We will go through them. So without further ado, let's talk about the real basic stuff, which is at what point has a startup reached Series A level? And is that point the same as them being a scale up, or are they different things?
Should I hop in first?
Go ahead.
Let me give it a go. So when you start your company, you haven't validated anything. You have an idea, and you're now trying to get people to place a bet on what you do. But there's nothing to indicate whether this bet will be paying off or not. So in the really initial stages, you're going to be finding angel investors typically making smaller bets. But as you're looking to raise more, those bets get bigger and people are looking for more validation. So for me, I think the starting point, which something I heard, which I think is really valuable and I now use at SeedLegals, is you think of your company in 2 parts, startup and business. And a startup is something trying to find product market fit. You don't know if it's going to work or not. You're trying something, you know, when we might launch a new product, we don't know if it's going to work. We can take a bet on it. But the other parts of your business or company are what we call business. And that is where you know exactly how much your customer acquisition cost is. You know how much you're going to make from each customer. You know how many you're going to sell each week. And it's all about spending more money on marketing, pay-per-click, you know, whatever it might be to increase your traction. And I think if you keep these 2 models in your mind, where you now jump from angel or seed to Series A, it's when your company is fundamentally switching from startup. Of course, you're always going to be doing new things, but switching from, I'm going to try this, I don't know if it's going to work, to this is working, we're just going to spend more on it to, you know, take over the world. And at that point, that's when VCs hop in and it fits the VC sort of risk-reward model. Over to you.
I love the take over the world thing, Anthony. People have often said to me, what's the long-term vision for Boardroom Advisors? I always say world domination, because every entrepreneur wants to do that and has to have that as their vision. So yeah, I always think that the clue's in the name, isn't it? Scale up. So you need to test and measure in startup phase, get it working, and then you are scaling up what you have made work. Relatively simple there.
Yeah, and I think Anthony, you described it really well. If you have like a spectrum of tech risk on one side and market risk on the other side, you want to be over the midway point. You want to show that you've got an MVP, you've made some early clients happy, and you've identified what is it about your technology that made them happy, and who is the buyer that you made the happiest. And then you look at the market and you identify, okay, I have 3 of these clients. I've identified 100 that have similar buyer behavior. And now I just need to actually be a CEO myself and not the head of sales. And I need to replace myself with a team of salespeople to hit up these 100 that I know will be happy with my technology, and I know they're happy to pay for it. And for that, I need a couple of million quid.
So I think one thing that's quite interesting, and not that many people know it, and we wrote an article, one of my colleagues at SeedLegals, who's an ex-VC, wrote an article, and it was even a bit of an eye-opener to me. So when you raise from angel investors, you know, they typically getting their SEIS or EIS. They've got a small number of companies in their portfolio. Maybe you're the only one, or maybe they've got 3 or 4. So what they're typically looking for is a high reliability of maybe a 3x return on investment. I mean, the bank's giving you 0% right now. So if you can get your 50% SEIS savings and have a good chance that you'll get, you know, 3x your money in a few years' time, that's a fantastic investment, right? Of course, it doesn't always work out, but if you can make it as high a chance as possible. With a fund, the maths are quite different. So what a fund is looking for is a return on capital, a return on its fund, because of the way it follows on and its own fee structure and various other things. Funds have seen that their investments obey a power law, which means of 10 investments, 1 of them will make a 50 times return, 2 or 3 of them will make a 3 or 5 times, and the others won't make anything and will lose money typically. So when you talk to a fund, it's completely different to talking to an angel investor. The angel's going, hey, this is awesome, I love it, you could be a bit bigger in a few, I'm in. The fund's going, will you be a unicorn? Yeah. And the problem with that is that for many businesses, that's just not appropriate. But it also, that risk playing a game of poker is a bit weird, because if I come home and talk to my wife going, hey, I'm doing this new startup, you know, there's a 1 in 100 chance we'll be a unicorn, 99% will go broke. She's going to look at me and go, dude, you should get a proper job. But if I go, you know, look, there's a 70% chance we'll have a decent return in a few years, she'll go, you know, okay, have fun. Let's check in a few months' time and see how it's going. So funds will only be there and ready when you exhibit that giant outcome and you're ready to throw money and scale. And the typical problem is people go to a fund too early and then they say, come back later. But now I've spoken too much, and I know I'm going to, you know, hop in with one of Isabella's next questions. So Isabella, back to you.
Well, sorry, before you do, Isabella, can I just jump in?
Yeah, go ahead, please do.
I think one of the important things there, 100% right, obviously, Anthony, and it affects your whole strategy if you're raising funds, because it's all about, I always think fundraising is a marketing operation, not a finance operation. Because it's who is your target audience and what's the message you want to get to that target audience. And if you're seed and your target audience is angels, and your message, as you rightly say, 3 to 5 times X and so on. But if you're at Series A, your target audience is the VCs and funds and so on, and it's the hockey stick curve. It's being a unicorn, and we're at that scale, that stage where we can scale and get to be a unicorn. Totally different game, and your deck needs to reflect that, and your team needs to reflect that. The fund, the VC needs to have reassurance that you have not just the proposition and the early stage customers, but also you have a team that knows how to scale. And that's a very different thing than 3 techies who've got something really wonderful and a handful of customers. You need to convince them that you can scale, because they might, you know, the VC, the fund may put somebody on your board, for example, but they're not going to run your business for you. You need to show them that you have some senior people around on your team. Sorry, I'm rabbiting now.
No, it's okay. And that actually does lead us on quite nicely to the second part, which I want to be a little bit more practical. And so I'm going to ask you individual questions that change you need to be focusing on, versus when you're a seed raise and when you're at, Series A. And I think the first one will go to Jonathan, which is from the investor side. You guys at Mountside Ventures, what are the metrics that you're looking at with companies to say, yeah, okay, we need to focus on all these things? And how does that change from the angel side?
So I'll start from the angel side. So fundamentally, the thing to think about that drives the entire institutional fundraising process is angels invest their own money. If VCs and institutional investors, they're investing someone else's money. So they have a duty to their LPs and their investors to perform good diligence, to hang their hat on something tangible and real, and not just a promise that you'll be a $1 billion opportunity. So at the seed and angel level, it very much comes down to, as John said, like your team. Are you a credible team that can execute? Are you in a big enough market for this to have the potential to be a unicorn? Series A is then on back to the spectrum market to tech risk. You're on about the halfway spectrum. So it's all about repeatable business metrics. What have you done to date, and what can you do going forward? And so when you are going into a Series A round, you want to be changing things from opinions to facts. And this comes back to what you said, is this a finance game or a marketing game? And I'd argue that marketing your equity is both. So how do you make your equity look the most attractive? And that is taking what you've done, and that might be, for example, having 3 or 4 clients. If you're B2B, you might have no idea what your CAC is. But having those 3 to 4 clients, having those early metrics where you can show that you have the early signs of product market fit, you've got a marketing channel that works, you've got a sales channel that works, and you just want to pour a load of fuel on it. Because if you think about a rocket ship, angels want to help you build the rocket ship. They want to take a big valuation uplift when the rocket ship's built. VCs are going around with the rocket fuel can, trying to find the right rocket ship to pour the fuel into. They don't want to help you build it. They just want to help you take off. What that looks like from a metrics point of view is very different if you're a marketplace to if you're a B2B company or B2C. If you're a B2B company, you want to have visibility to $1 million revenue. What does that actually mean in practice? It can mean that you're on 400K revenue, but you've got a good pipeline. You've shown how long it takes you to convert that pipeline. You know how to find a budget holder. And so if you have 10 million pounds at the top of your funnel and you've shown how you've closed 1 or 2 or 3 clients, then you can start taking the weighted value of that funnel, pushing it into your traction. And then you start being able to validate that even though you're not currently billing $1 million revenue, you are $1 million revenue company. If you're B2C, maybe if you want to go into an institutional round, you really need to be at the round at least 10,000 users, not downloads. I'm talking about people actually using your platform, not people who download it and they haven't gone through KYC or compliance. And then if you're a marketplace, then it gets even trickier. It's like, how do you charge? You can have 10 million pounds going through your marketplace, but you might only be making a couple of quid. So generally rough revenue wise, you want to have that visibility to $1 million for B2B. You want to probably be above $1 million gross market value, showing your net market value being appropriately revenue generating. And on the B2C side, kind of the rules change, especially if you're a consumer fintech. You probably don't need that many metrics.
A segue question actually came within the chat, which is, this is a niche, but what about for travel tech companies that had very good revenue pre-COVID and are now maybe looking for that Series A step up to get them out of murky waters, but also really hit the market quite hard? Do you have any metrics around what they should be looking to show to their investors?
A mid to top tier VC wants to see 8 to 10% month-on-month growth. What that month-to-month growth is on, again, comes down to how do you market your equity. But if you have shrunk significantly during COVID, then a LP-driven investor is probably not right for you at this time. Probably looking at some of the EIS funds, some of the VCT funds who are tax-efficient investors And because their investors get a significant chunk of their capital back, as Anthony commented on earlier, they don't need the level of required returns. So if you have a good acquisition pathway in a 3 to 5 year horizon, they probably would be, if it was me, where I'd focus my attention for targeting investors.
And the last question to you, and guys, also feel free to pitch in wherever you think necessary, but is there generally, broadly speaking, a minimum amount VCs are willing to invest, or does that depend on what their vertical is?
It all comes down to the size of the fund. So if I think about Dawn Capital raised £400 million fund the other week, it all comes down to the size. So if you have a £400 million fund, you're not going to be cutting £1 million checks, because otherwise you'd need hundreds of people doing DD at all times. If it's a 20 million fund, yes, probably you do want to go to them if you want a £1 to £2 million check. But if you think about the fund itself, and it's all about the distribution curve and the power of law, and they wouldn't be cutting £102 million checks, because it just doesn't make sense from a statistical point of view. If you want VC money, probably you'd be looking at a million quid minimum in a ticket size. The average Series A is probably more like 4.5 in terms of if you look at the statistics.
Okay, cool.
And
sorry, go ahead.
Yeah. I was going to say anything lower than £1 million. There are a lot of EIS funds and formalized angel networks. People like 24 Haymarket and Newable are VC funds that kind of manage angels who invest under the EIS rules. So there is capital there. But if you want VC traditional money, at least probably 1.5 to 2 million quid.
So I'll hop in. So that's actually really interesting, because, you know, when you go to angel investors, the minimum ticket, I mean, if it's on a crowd platform, it's £100, but, you know, with angels, it might be £2,000 or 10 or £20,000. So if you can easily raise a few hundred K. The problem with the VC is, you know, as you say, if they've got 100 million that they need to invest each year, I mean, they have to invest money, but it takes them ages to do the due diligence, which we'll get to in a few minutes. So they do relatively few investments, which means they have to do bigger investments. Otherwise, they just can't get rid of their money fast enough. And that means that they have two criteria which really influence things that are vital to know. Number one is what's their minimum ticket size, and number two, what % equity do they want? So when an angel invests, they know they're going to get, you know, 0.5% or 0.1% or whatever. It's fine. With the VC, they want to have some influence on the company, and they also know you're going to go through a few more rounds later and they're going to get diluted. And because they want to be get a big chunk of money at the end of it, they're going to want to get 15, 20%, maybe at minimum, maybe 10%. So now you can do the numbers, which are, if you're talking to a VC and their minimum ticket is, let's say, £2 million, and they want 10% of the business. This means that you're looking at roughly a 20 million pound, should be 18, but 20 million pound valuation. And so now, a couple of things: can you hit a 20 million pound valuation? If not, you're going to start giving away more equity than you wanted, or you just going to have a mismatch between the amount that you actually need right now and can justify and the valuation. And that's the key problem that I think most people on the call are looking to solve, which is what I call the come back later problem. So you go to a VC and they go, "You're awesome, we love what you're doing, it's amazing, come back later." And you're always being told, come back later, no matter almost what stage you're at. And the key is to know when you're ready to talk to a VC. And I think there from John, you got the super critical piece of information, which is, the rough benchmark is, are you doing £1 million a year in revenue, or on track to that, right? It might be half of that, but if the numbers are going up, you can go, listen, if I were to come back in a few months' time, it would be exactly there. Let's talk now, because it's going to take you a few months to sort things out anyway. And that is the key. And if you're not at that point and cannot justify the valuation for the minimum ticket size, then it's a comeback later.
I'm going to move over to John, because in those shifts where your investors are expecting different things, you do need to change stuff internally, governance-wise, right, John? And so what I want you to answer is, what is the key parts of the business that are seeing big change, and how can advisors and external counsel help with that process?
Well, yes, they're a different size. It's probably more about having, rather than, I mean, governance is important, but that perhaps is even later. It's more around having the right advisors on board, people who have scaled businesses before, people who can convince the funds that they are going to scale this business, rather than, you know, 3 people with a great idea and no idea on how to run a business. Somebody said it earlier, I think Anthony, very different from having an idea and a fledgling business and test and measure and you know, getting some stuff wrong, getting some stuff right. It's very different from that. And then you've worked some stuff out, but then you have to build a business. So you need people in your team, in your slide deck, who have built businesses. That is absolutely 100% critical. And governance kind of comes I guess as part of the investment, but at the stage of investment, it's more about the quality of the team, have they scaled.
And what changes in that, you know, when you first start, for example, a SaaS company, you're looking for a sales team, you're looking for customer support, you're looking for a head of sales. When you get to, okay, we have operations in place, and now we're just looking to massively grow, you know, that revenue, who are those generally key people that people are bringing in, or does that depend on what sector you're in?
It completely depends on the business and the sector. Sales is 100% critical. Where without sales traction and without growth, be that 10%, 20%, whatever it is, so sales is absolutely critical. And one of the problems often is that at seed stage, there isn't much money to pay people. Maybe there's some sweat equity gone out to some people. Maybe the team hasn't been able to afford a heavy hitter, so they've had to downgrade. So they don't perhaps have a big sales director on board. Perhaps they have a sales manager. Well, that's really not going to cut it at the next stage, because the funds will know that they need somebody serious and heavyweight in order to take those sales on. And the same goes in other areas, but sales is absolutely key.
So if I can hop in quickly, so I think one of the fascinating things, which is a real pain point for many early stage people in a company, is when a company starts, you know, usually a few founders got this vision, we're going to solve diabetes, fix this, change the world, whatever, and they're on this mission to do it. If they succeed in step 1, you know, they've surrounded themselves with people who've probably joined because they like the founders, they like the mission. And now when you're going to raise, you know, if you want to have a profound effect on the world, you need to have a larger company and a larger influence. And that means at some point there's going to be a sort of middle management and putting people in place who are much better at those things than the founders are. And so we saw that at SeedLegals, where after our Series A with Index Ventures, they went, you know, Anthony and Laurent, we love you guys, business is great, here's a big chunk of money, and now the very first thing we're going to do is we're going to help you hiring head of sales, head of growth, head of marketing, and so on, so you can do the next step. And those people spoke a slightly alien language. You know, for me it was, you know, being awesome to customers, cool legals, changing the world. For them it was OKRs, metrics, sales, and those can alienate earlier people in your company because, you know, things are different. But if you want the company to grow, you have to recognize and indeed embrace as the founders that change.
And I think also, sorry to interrupt, I think also it's important for the founders to realize where their individual strengths are. And you may have 3 founders and one is the chief exec because nobody else wants to do it, and you know, he's a bit of a leader. But that doesn't, at startup stage that may well be right, but at scale up stage, you know, there's going to be a business, there's going to be a business machine running here. You need to know how to build that machine, you need to know how to run that machine, and founders often, very often, aren't the right people to do that. And so there needs to be a degree of realism that actually I'm a techie, you know, perhaps I'm a CTO or a CIO, I'm not a CEO, and somebody comes in, you know, even Google did that. You know, they shipped in a big CEO. because they weren't the people to drive that forward.
And when you have repeatable, sorry, Isabella.
No, go ahead.
And it comes back to, I guess, what I commented on earlier is, once you understand how your funnel converts, how you move from initial meeting to RFP to tenders to signed contracts, once you understand the length of time and the conversions between that, the levels of your funnel, you understand what your sales process is. And then, so if you're the CEO, you've been doing 90% of the sales to date. You have to have the awareness that post Series A, you need to replace yourself as the head of sales. And so if you don't understand how your sales process works, you don't have that documented, you don't understand the conversion ratios of your funnel, then in the investor's head, you haven't de-risked the replacement of yourself.
Yeah, really important. I think we've lost Isabella. We can't hear Isabella.
I'm still here. Yes. Okay.
Yeah.
I think that does move on to then, when a founder starts their business, they're thinking, okay, I need some money. I want to get this off the ground. What are the changes in what founders should be expecting from their investors and looking for in their investors when they hit this very significant Series A? Because the ball game is changing. Equity is being given away, rights are being taken away. So what should they be looking for? And I think I'll start with Anthony, because you obviously went through Series A last year with SeedLegals. What were you looking for in your big investors?
I think there are two parts to the question. What are you looking for in the investors, and what are the investors looking for in you? So mileage varies with founders, what they're looking for in investors. Some of them are looking for friends, some of them are looking for advisors, some of them are looking for cash, some of them are looking for board members. For me, I like to keep the role of investor and advisor separate. Investors, it gives someone who gives me money, and I am going to do my utmost to give them a great return. An advisor is someone I pay money or give shares to, and they're going to give me advice. And if they stop giving me advice, then I'm going to terminate. But if you try and conflate the two, you can't get rid of an investor. They're a shareholder. It's very difficult to get rid of them. So if they become an advisor as well, then that's a bit more difficult. So from my side, I think people often overplay the value that investors will give you. They'll tell you all this amazing stuff that you'll probably never hear from them again, unless they want their updates. But Jonathan will tell us more about that in a minute. I think it's probably more relevant, I think, is what the investors are looking for from you. So angel investors, dude, give me my SEI certificate. Tell me periodically how things are going. Send me cool materials so that I'm feeling happy. And when you want to hit me up for more money later, I don't go, who are you? You never spoke to me after last round. But when you have funds, they have, a whole lot of reporting obligations. So they're going to want to ask for monthly or quarterly reports and projections. And this is where ideally you find a business partner who loves that stuff. So my business partner, Laurent, is a genius at those Excel spreadsheets. When we have a VC, board meeting with with Index Ventures, and they go, what's your customer acquisition on this cohort? Laurent will go, wait a minute. Here it is. I've prepared the slide for you. It's just like, that's amazing. I have no idea how that works. Anyway, over to you guys.
Oh, Anthony, just to jump in, I absolutely, you hit my pet subject. Keeping advisors and investors separate, 100% essential. Because if you're an investor in a business, the advice that you give is tainted. It may be, tainted sounds really negative, but it's biased. It comes from one angle. And you want advisors to be paid money, and you're quite right. If they don't perform, you get rid of them. That's absolutely 100%. Sorry, I'm on my hobby horse.
And you just nailed the governance mismatch of having an investor. An investor is financially driven, but they are given an investment director seat on your board. So how do you match up the fact that you have to act in the company's best interest and the fund's best interest at the same time?
There you go.
It's quite a paradox.
Yeah.
My 2 cents on what's the expectation from investors, purely network. I'd go into any funding round expecting nothing and then being pleasantly surprised if you get anything. But it comes down a lot to the fact that all startups are different. All of them have their individual USPs. What's a fund's USP? How does a fund competitively differentiate itself from another fund? people like Index are incredibly good at that because they're on fund 7, 8, 9. I don't know what they're on these days, but they're a generational fund. So they have the marketing and the brand. Many emerging fund managers don't have that. So how do they differentiate themselves? And so they sell themselves on their network. So if you're a B2B company, like I said earlier, and you have your early customers and you say, here's the target of the other 100 customers I want, that will bring me to a 300, 500 million valuation. How many of these on the list can you open a door to? How many can you introduce me to a budget holder to be able to get a meeting? If you're a B2B company, that would be my primary question that I'd be asking. If you're B2C or a marketplace, probably a bit less value add from investors. Like you'd probably want someone who can help you test marketing channels, test different types. Maybe it's someone who's implemented really good referral programs in another company, and that's in your roadmap or something that you want to do. And then the final thing is recruitment. VCs have good networks. Some of them have good networks. So if you want to make quality good hires from a warm introduction, that's something that VCs pride themselves on being able to help you with.
Yeah.
The other way around, investor expectations. Probably stick to the business plan that they invested into. It's the main one. Because they have a duty to their LPs. If you pivot your business significantly, obviously, except if you're currently failing or you're stepping away from the business, then that really hurts their fund mechanics. And if they're raising capital is all about the spectrum again. I'll talk about spectrums. The fear of missing out versus the fear of them losing their job. And what your job is as a startup is to essentially allow them to allocate money into you without the fear of them losing their job in the future.
So I have a question for Jonathan, which is that, in the UK, my perception is that it's a sort of a buyer's market for, so in other words, there are more people looking for investment than VCs. Therefore, VCs can be quite picky and you need to really sell yourselves to them. My perception is in Silicon Valley, if you're one of the hotter companies, in fact, you've got VCs competing to invest in you. And that's why we see some of the, what we think are insane valuations from the US, because VCs need to, why am I going to go to you when I could get Sequoia or somebody else? Do you see that difference, and where do you see the balance between the buyer versus seller's market at the moment?
Yeah, this is really interesting, and then I'll probably get in trouble for a few things that I'm going to say.
That's okay. No one's listening. It's okay. You can talk frankly here.
VCs in Europe constantly complain that all the deals are overvalued. They think that they're investing at too high valuations. They're constantly trying to push founders down. But all the top name US funds are now opening up offices in the UK and Europe because, in their perception, deals are really cheap here. So there's a level of competition, and VCs, and the reason why Series A deals have to market themselves to VCs rather than the other way around is, as you said, there's not enough capital in the ecosystem. And so I'd be quite wary of any VCs trying to hammer you down on your valuation, because macro-wise, there's no real reason why valuations in Europe are so significantly smaller than in the US at the early stage. As a lot of the big VC names like Sequoia, they just opened up their office in London last month or the month before. And there's a very, very good reason for that, because they want to find cheaper deals.
So after we had spoken to many VCs, all of them try to, if not push down the valuation, at least come up with their own multiples of annual revenue and so on. And their numbers are usually lower than your valuation estimates. And it's always a bit of an uphill battle. After we closed our round, I started getting incomings from US VCs. And I think one of them sort of put it more clearly than anything I'd heard, which is, normally we invest this amount. The valuation, actually, you don't really worry about the valuation. You come up with a number, because if it's a hot company, we just want to be part of it. It's like, okay, That's completely different to anything I've heard. So maybe the takeaway point, if you're on the call, is how do you make yourself look more attractive than others? How do you create that fear of missing out in yourself? And also, how do you, importantly, create competition with VCs so that you can walk away, you know, if you want this valuation and someone's offering of that valuation, if you have no one else, you kind of need to take it. Now, this, of course, is easier said than done, but trying to get inputs and term sheets from more than one investor is really important to try and get the best deal, and often just to close a deal. And I guess, you know, John and Jonathan, you guys have seen more of those than I have. So what are your thoughts on shopping around and creating competition?
Competitive tension is the only way, realistic way, to close a deal on better terms and better timelines. If an investor knows that they're the only one in a race, they'll tend to dictate terms and timelines. And so if you're not able to build competitive tension, the best way to have competitive tension off the bat is to prepare heavily for your funding round. Have all your due diligence in place, have all your investor FAQ in place, have 90 to 95% of questions the investor is going to ask answered before they ask them, which is something, John, I'm sure you're very involved with helping your companies with. And then if you have a first meeting with an investor, they send you a huge list of DD questions, and you reply to that within 24 hours with really meticulous answers. Even if no one's in the race, the investor thinks that someone else is in the race and has already asked you those questions.
And do your marketing. It's a marketing exercise, and that means who are your target audience? What's the messaging you're getting out there? Have you got enough people in the race to start with? Because it is partly a funnel. And you know, if you have more people in the race, there's going to be more competition, and the valuations are likely to be in your favor, and it's likely to get away quicker, I think.
Yeah, so talking very quickly about due diligence, everyone's least favorite subject. But super.
I'm an accountant, Anthony, so it's not my least favorite.
Okay, so when you're raising money from angel investors, you know, when you do your round on SeedLegals, there's the disclosures and warranties, and most angels, I think, either don't know or don't care. You know, you need to go through, as the founder, a whole list of assertions. The company owes no tax, there are no outstanding loans, there's no, you know, second party or first party agreements and things like that. And angel investors often don't know this stuff. Their investments are sufficiently small, they're not going to worry too much about it. And then the sticker shock arrives when you get your first VC or serious pro serial angel investor, and they send you a list of 27 questions and or more, and now you're in a mad panic trying to satisfy this. And some of the questions are super simple, which is, you know, show that the company owns all its intellectual property. And this means going and finding everyone who's ever worked on your project and making sure you've got a signed agreement with an IP assignment and an NDA and, you know, work conditions and so on. And otherwise, if you can't show the unbroken chain, it's a problem. So in my earliest startup, 2 startups ago, when I got this, there was this like, oh my God, what do I do? Ruffling around in shoe boxes at home, hoping I'd got agreement signed on a piece of paper. And it took me literally 3 weeks to sort that. In my next startup, it took me about 3 days. And on SeedLegals, now my documents all on the platform, it took me about, you know, 3 hours. Of course, I passed some of it on to my business partner as well, so to be fair. But, you know, when you are expecting that, and know from the start that you should prepare these documents, keep them in the same place, in a safe place, somebody will ask for them later, that is going to make things so much easier later.
Yeah, we call it Netflix work. On a Sunday, watching Netflix, just dragging employee contracts into a G drive and dragging your director service agreements, all of the nuts and bolts of your business. The important thing there as well, and just tangent topic, only ever give access to your data room away after signing the term sheet. Never let anyone in before that. It's the nuts and bolts of your business.
And that leads me to the most important question of this, because everybody here, our founders, is gentlemen. How do founders protect themselves going into this process? What documents do you need to have in place? How should you be talking to your investors? Should you be mentioning NDAs? I would really like to hear, I mean, I think first from Anthony, because he is going to give the legal side, but from all of you, because you've all started your own businesses as well as invested in others.
I'll probably actually add less than others, so I'll be brief. I think founders have got, well, firstly, some of them naively think you should ask your investor to sign an NDA. The investors will never sign an NDA, as I'm sure John and Jonathan will tell you in a second. So don't ask them to, because it'll be, they'll just think, you know, you've never spoken to anyone else before. You should only share things that you'd be happy to share without an NDA. I think, however, the more worrying thing for a founder is when they have VC term sheet received, they begin to worry how they may be ousted from the company. The board with an investor director, they might get rid of me. So when they started the company, they had 100% of the shares. Then they did an early stage round. There was no investor consent. There were no, you know, other board members, or if they were, they appointed them and they could get rid of them. And now they see a range of other things and fear that the company can, or the investors can get rid of them. And if they've got sensible deal terms, that's generally a misplaced fear for two reasons. Firstly, at a governance level, it's actually rather hard to get rid of a founder unless they've done something really grossly wrong. And secondly, the investors, at least early stage, are investing in you. It doesn't make much sense for them then to get rid of you. You've also got a good fraction of the shares. So, you know, I wouldn't obsess too much about that. I would try to make sure you don't lose control of the board and drop below 50%, although inevitably when you get to a certain size, you'll get there. Guys, over to you.
Do you want to kick us off, John?
No, this isn't really my special subject. Yours and mine, I think.
Sure. There's three terms that are quite sticklers for founders that instantly came to mind. The first one is vested shares. So essentially, when you get investment from a VC, you get your shares ring fenced, and you have to earn them back over time. Psychologically, as a founder, you're like, why the hell do I have to earn my own shares back? It's my company. But in reality, the VC is just trying to lock you into performing against your business plan. They want to vest your shares over 4 years just to say, please don't leave us out in the cold and please don't kill our deal. But it's quite hard to mentally prepare yourself as a founder when you see that term for the first time. The other one is generally there's a clause saying if a shareholding drops below 5%, then you lose your board seat. And so as a founder, if you think you're going to become a unicorn and you start working out on the back of a piece of paper, you're like, oh God, Series C, I'm below 5%. Does that mean they're going to oust me at Series C? So that one can be a bit of a stickler as well. The other one is if you don't have a chairman going into a round. A Series A deal we helped earlier in the year, they didn't have a chairman, and then their investors, it was about 4 million Series A, was 2 million of one investor, 2 million of the other, and they both demanded a board seat. And so he had 2 board seats previously. Suddenly he has 2 investment directors, and both investment directors were like, we've got the perfect chairman for you. And so if they bring in a chairman, then yes, they have to be independent. Companies Act legally required to be independent. But in reality, do humans work like that? Can you ever be completely non-biased? And so suddenly after the Series A round, you went from having 2 board seats and quite an easy time to suddenly 2 investment directors and a chairman as well in the space of a few months. So that's very hard to deal with from a governance level. And advice I always give to founders is you control the board. Never let anyone tell you what to do. They're only there to advise, never to tell.
So a couple of things rising out of that, really. One is, as you rightly say, you know, if there's only a couple of founders, so therefore perhaps a couple of directors, you can easily get outweighted. So think about the number of directors that you have before you go to Series A, because there will be investor directors going on the board. More importantly, think about a chairman. And think about a chairman that's suitable for Series A, because your chairman, if you have one, your chairman at seed isn't necessarily the sort of chairman, the heavyweight chairman that you need for Series A. But in a perfect world, to have that person in place before Series A means, as you rightly say, Jonathan, it's about controlling the board. And the chairman plays a seriously important role, not just in his voting rights, but in controlling things in the company. So you want the right person, has to be obviously independent, but perhaps think about that before you go Series A.
So just on the chairman, I've never been a fan of having an additional person that's sort of just the chairman. And in my model, you know, one of the board members acts as chair, and in our case, my co-founder acts, you know, chairs the board meetings and does a great job of it. He does all those board minute prep that I'm rubbish at doing, and you know, sets the agenda and then raises the points beforehand and follows up and so on. And I haven't seen it as being desirable to bring in yet another party. What are your stats on what % of companies have a sort of additional person as a chairman, as opposed to just one of the people on the board chairs the meeting?
I can't give you stats off the top of my head, Anthony, but I think the key thing is, you know how we were talking about earlier about investor and advisors and trying to keep those two roles separate, and having somebody who's an executive director being a chairman, which is a non-executive role, you're mixing apples and pears again. So the chairman, in principle, in theory, should be non-executive, should be outside of the day-to-day, should be able to control the board, give people equal weight, not have an agenda for themselves on a day-to-day basis. And that's the problem. Your co-director may do a fabulous job. I'm not suggesting that for a moment, but it's tricky mixing apples and pears. Keep a chairman as a non-exec if you can, and if fees are an issue and you're worried about having too many people and therefore it costing too much, then in the early stage you don't have board meetings that often. A chairman isn't going to be that expensive because he's not going to be doing that many days. But I would certainly keep it separate from an executive position in a perfect world.
So good point. How much should people pay for a board member, advisor, or chairman? What are the going rates? If someone says 20K a year, is that too much? Is that sensible? You know, if it's the suitable high-profile person, what are the metrics?
Yeah, it obviously depends on the company, but if we're talking about Series A, I think it's better to think in terms of day rate, because if you look at £20,000, that feels a very big number. If you're talking about perhaps in the range of £1,000 to £2,000 a day, let's say, and how many days is a chairman going to be needed at Series A, and how is that going to be quarterly board meetings or monthly board meetings? Is that a full day or a half day? It can actually be quite a small number by the time that it's done. So much better to think on day rate, and better to have a big heavyweight chairman and have less of him than have somebody
or her.
Sorry, yes, I use it generically. Than to use up lots of their time. Don't get them doing lots of stuff, particularly the chairman. Get them chairing the meeting.
Okay. One thing I'll say that goes a bit against the grain of what you both said is, from an investor perspective, if we go back to the spectrum of tech risk to market risk, if you bring in a big hitting chairman who knows everything about your area and they've got skin in the game, i.e. maybe they're an angel investor that then became the chairman later on, you're de-risking the tech risk. Because if I'm an investor, an agnostic investor, and I see this chairman who has skin in the game backing a company and putting significant time in there, who am I to tell him that, or her that they're wrong? Like they're a sector expert. So it can help a lot going into an investment round if your advisors also have skin in the game.
Okay, cool. Should we take some of the excellent questions that I've seen appearing?
I didn't want to cut you guys off. You seem like you were on a roll there. Great chemistry going on in this webinar. So actually, this is one for John, which is to do with how do you remunerate advisors? Is it milestone investing? You should talk about vesting schedules generally. Is it cash? What do you see, and what's the difference when it's at seed stage or at Series A stage?
I'm a great fan of paying cash to advisors, and paying, because you are paying for advice and paying for a service. Keep it simple and separate it from anything else. If they're not performing, get rid of them, find somebody else. It's a nice simple model, and it keeps it clean.
But would you pay up front and then they don't perform and then you're out of pocket? How do you balance that?
Well, as I said earlier, if you're paying on a day rate, and perhaps you're taking somebody on for a period of 3 months on a trial basis, and it works, and you extend to 6 months, you're never really financially exposed terribly much. And hopefully you've done your due diligence and taken advice beforehand. Choosing somebody in the first place is the trickiest bit. I think in terms of advice, it's about drawing up a specification. What is it that you need? Often when we talk to people, they're not really clear what they want from an advisor. Be really clear in your own mind. I need somebody advising me about sales. I need somebody advising about exit. I need, be really clear and almost have an identikit. Perhaps they need to know about my sector. Yes, but in how much detail? Do they need to be a sector expert, or do they need to be a scale-up expert? Just be really clear about all these types of questions in your own mind, have an identikit, and then go and find that person. Don't rely on a friend of a friend who's been recommended. Recommendations are great, but have a clear idea in your own mind what it is you're looking for in the first place. And I would suggest even having when you do recruit for anything. I've recruited quite a few people in my time. We used to be very clear about the things that we were going to measure people on, and we would grade and scale them when we did an interview, so that days, weeks after the event, you've got a scale of 10 that you're ranking people on for each of the skills that you're looking for. So be proactive about looking rather than reactive. Oh, Fred seems a good guy, he might help us. Yes, but how? What is it you want? Sorry,
investors will charge you monitoring fees as well. I regularly see investment director charging 20 grand a year for their participation in the board.
And I think that to me is a tricky one, right? So if you want someone on your board and they're going to bring value, either just as an advisor or actually on the board, then you're going to pay the money. The irksome thing is when an investor says, I insist on a board seat here, fine, you're investing, and I want you to pay for it. It's like, I feel like I'm being diddled here. This is part of getting your money back. So, then if it's 20K, that sounds quite a lot for, forced paid investor direct position, 5K, CMZO, whatever. If you can do it for free, then it means you're doing it because actually either you really like me or you're doing it to help the company and you've got skin in the game. So if you can try to not have to pay for directors or a modest amount, certainly pay travel expenses and so on, that's great, but you beggars can't always be choosers.
Yeah, and it's monitoring fees plus the arrangement fees plus the companies is also expected to pay the legal fees plus due diligence fees. The fees rack up and up and up. Kind of 5 to 10% of the round is probably what you should, to be honest, allocate just for deal fees and ongoing. A lot of the EIS funds will charge all of their fees up front and net it off the investment amount, which can be up to 10% of the total amount. And
don't make the mistake that I made 30 years ago of turning down a deal because the fees were so large that I thought it was ridiculous. But I turned the money down. 4 years later, I closed the business because it ran out of cash. There are some fees, and you have to give some shares away. Accept it, move on.
And then this is actually quite important when you are obviously scoping out the market and choosing your investors. How important is it to make sure that you get different investment opportunities, but without divesting different valuations that could come round, I suppose, to cause you problems later, and have too many people have different valuations of the company? How do you get around that?
It's very hard to align different strategic investors under the same terms. Like if you have a deep tech investor and a fintech investor, trying to get them under the same terms and the same strategy is always a struggle and takes a significant amount of time. And that's where your advisors and your lawyers really kind of can earn their fee, is helping manage that process. Because as a founder, the one thing you really, really have to avoid in a funding round is diverting your attention from running your business. Your real objective is make your clients happy, make your employees happy, and make sure your tech works. Not spending every minute under the sun just speaking to investors, because your growth will stunt if you don't divert your attention in the correct way.
Yeah, I'm conscious of time. We have time for about one more question. And for anybody else, when you do receive the recording of this, you will get links to the websites and details for all these gentlemen. So don't worry, you will be able to ask your questions. But actually, on the point of founders that have obviously been bootstrapping for a long time and have been perhaps low on cash, somebody asked, well, what do they do if they do want to take money out and kind of pay themselves back at a Series A stage? And I think, Anthony, you can probably give some insight into this based on the data SeedLegals has.
Yeah, so I mean, our data shows that when you start a business, nobody invests just on a PowerPoint because, you know, ideas are cheap, implementation is expensive. So our data shows founders put a median of £26,000 of their own money into the business, you know, before the first round. Sometimes it's a lot more. And then the idea is you might repay yourself later. So that's, you know, sort of taken as read in early stage rounds, and on SeedLegals, it's a one-click to go. I can, you know, pay back with board approval or investor consent when the company reaches cash flow break even, for example. Where it becomes, I think, more difficult is if you have raised money and now the company needs more money if the founders put money in. And of course, when there's just a couple of founders, the amount that's put in is moderate, 20K here or there. In the scheme of things is not much. But if you start putting in, as I've seen some founders, a couple I've seen have put in like 500K, that as a loan repayment is significant because investors want their money to grow the business, not to pay back the founder. So if you've got a giant founder loan, you may find it becomes problematic later. And certainly investors, if it's 20K, they go, great, send me the receipts, you know, you're good. If it's 500K, they're going to want to see more documentation to make sure that it's, you know, not a cooked books kind of thing. Jonathan, you look like you wanted to say something there.
I always want to say something. I generally what I've seen is that before coming into the round, the investor will demand that the founders convert their loans to equity. I haven't really heard of many deals where they haven't done that. In terms of secondary liquidations, pretty much unheard of. Anthony, please correct me if I'm wrong, but pretty much unheard of before Series B. And then the way that you actually get money out of the business is post Series A. Your term sheet will give you a salary of probably, if you're a consumer business, around 50 to 60K. If you're B2B enterprise, maybe 80 to 100K, and that will be a formalized salary post investment.
Yeah, that's right. So by the way, you know, the conversion of your loan into equity only makes sense after your first round, because before the first round you own 100% of the business. I mean, the founders collectively, you can't earn more than 100%. So if you put money into the business, don't look to convert it into equity before your first round, because guess what, you'll still have 100% of the equity and your loan won't be repaid. It only makes sense after the first round to look to convert it. So can I, Isabella, hop through a few questions here in 30 seconds per question?
Sure.
All right. So Georgia, for B2B, what do you think about pilots where big insurers signed up with pilots? So my take with pilots is it's, you know, investors are looking for validation of your model. Real validation is customers giving you money, either as a one-off or better on a monthly basis. Investors love SaaS models. So a pilot is a step towards that. And the question then the investors will be asking you is, the pilot really going to convert, or are you doing 20 pilots and no one's converting? So pilots are a great next step, but you will be examined on whether the pilots are going to convert and when they're going to convert. If they haven't converted, why not? Next one, I think we've covered what are the Series A criteria. We've covered travel tech. We've covered, we haven't really spoken about seed, but seed's sort of 500 to 700K that sits in between my angel investors and my Series A round. If you want to raise 500 to 700K, usually it's when the company's now getting growth, you've launched your product, but you don't yet have the metrics ready for Series A. Raising 500K or 700K from angels, that's probably quite a lot of angel investors you're going to need to find, you know, 10 or 20K each. So you may find an SEIS or early stage fund being one of the anchors in there, and then some angels as well. And that's going to be a halfway house between people betting on the founders and betting on the Excel spreadsheet of the numbers.
The next one is, do EIS funds typically look for the same level of equity as VCs? John or other Jonathan?
Yeah, generally 17 to 23 is what I usually see. They mark to sufficient ownership to justify a board seat without being diluted to oblivion on the next round. So yes, to the same ownership. What I would say is tax efficient investors have lower expectations of growth. So if you're playing in a 400, 200 million market, and you don't have that path to being a $1 billion company, then EIS and VC2 investors are generally a lot more lenient to the return profile expected.
As the saying goes, whatever you're raising, the answer is always 20%.
Yeah.
Yeah, chuck DCFs out the window. Generally just use the rule of thumb, which is quite annoying, especially from an accountancy point of view.
We're gonna literally take about 2 minutes and have like 30-second answers. So whoever has the first answer, go for it. So the first one is, if your business is B2B, B2C, but your market is high street banks worldwide, how many SaaS licensing customers do you need before you can credibly raise a Series A?
Well, I'll say 3.
Okay. On this point of vesting, I don't know, we've done this. If it's a B2B business that has an important growth since COVID, MRR is 30K. Is it a good time for fundraising at the moment? Who has an answer?
Well, the reasons for fundraising are twofold. One, because the growth is great and you can raise, or two, because you need the money. I mean, generally you're going to fundraise because you need money, or, you know, your business will benefit from money in order to grow faster. So if you think that COVID is going to long-term affect your business and you don't see any great opportunities right now, you might be better off hunkering down and getting to the next step. On the flip side, if you have pivoted, tweaked, or regardless, you think things are picking up and you think you can get investors' attention and stand above the crowd because lots of people are beating their way to investors, then you should do it. I think the last thing is, you know, I think the one thing you can't do as a founder is procrastinate. Procrastinate is just death. So you have to make decisions and you have to act to grow the business. Otherwise, you know, the money just drains down in the bank month on month. And if you're not cash flow positive, it's going to be gone. Yes. So you have to take advantage of the times one way or the other.
Wise words.
Last 2 questions is, what is the best way to value a B2B company? Big question.
How much are you looking to raise, and times it by, divide it by 0.2.
Yeah, so actually that's really my rule of thumb as well, which is we see on SeedLegals founders, or dilute by 15% in a round. We hear 20%. I think it's probably a little lower earlier on, a bit higher later on. So you can just sort of multiply the amount that you want to raise by 5, which is dilution of 16%, to get the valuation. Of course, this just moves the problem space slightly to how much do I need to raise, and there you're going to work out rationally your costs for the next year to, let's say, 18 months is ideal. 18 months plus these days, because nothing is a certainty, and you want to make sure you've got money for that period and beyond, and then that's the amount that you'd like to ideally raise. But I'm sure there are many approaches to that problem.
And really quickly, the 3 areas that are just outside of that is look at market comparables, look at your previous funding round and milestones hit since, and try and attribute values to each of those milestones, which is more of an art than a science. And the last one is, if someone wanted to replicate your business from scratch in terms of man hours and the amount of time you spent on the tech, how much would it cost them? And that's a good way of kind of creating a sensible range rather than a stick in the dirt.
That was great. And then last question, back to founder loans. Is it acceptable to convert the startup loan to a bank loan to enable part of the founder's investment to be recouped? Big last question.
Oh, that's tricky.
I think that's a kind of a special case. So it's I'm taking my money back from the company, and then the company's going to borrow money from the bank to pay the bank later. I think investors would look at it slightly dubiously and want to understand a bit more about how all that happened. But I think the biggest problem you'll have is the bank probably won't lend you money. And the reason is, if you could borrow money from the bank, you probably wouldn't need to raise investment. The whole point is banks lend money at 8% or something to companies who've got a very low risk and also a low return. You sell cheese, you borrow some money from NatWest, you sell more cheese, you give them some money back. Equity investors will give you money with a smaller hope of a return, but a hope, if that takes place, of a much larger 300% return. So as a practical matter, you're unlikely to be able to borrow money from the bank. And if you can, maybe you didn't need to do fundraising.
Can we eat the cheese?
Venture debt becomes in scope when you're a bit later on. You need kind of 2 to 3 million run rate if you want to raise from the likes of people like Silicon Valley Bank or Harvard. And there are some smaller debt providers like Shawbrook, but they only co-invest alongside institutional equity. So I probably wouldn't look at, unless it's government support, like significant debt funding until you're much later stage, because you just don't have the cash to pay off.
Yeah, so it's a great point, because sometimes people call and, should I take on debt? And the answer is, I think, simple. Do you have a cash flow to repay the debt? Well, no, I'm still developing the product. Well, you can't borrow money because you have no way of repaying it. So don't do that. When the idea is, so venture debt, for those who don't know about it, is sort of a bank that thinks a bit more like a VC, I suppose. Is if you go to Barclays and ask to borrow money for, your drone company, they'll probably ask you so many questions at the end you'll realize why they're not going to lend you money. But if you go to companies like Silicon Valley Bank or others, they will take a more forward-looking view that you will have a return later on. They might ask for a warrant and some shares in addition to the return on payment, so that they've got some skin in the game. But you can only really borrow money if you've got a capital revenue that you can use to repay that.
And that brings us to the end of this actually quite long webinar. Everybody, John, Jonathan, Anthony, thank you very much for being here. I think everyone got something out of it. And just to remind everyone, you will be receiving the recording, because I know there was a lot of information. So I'll let you guys say goodbye and I'll press the end button.
Bye, everyone.
Thanks for having us.
That was awesome. I learned a lot. I'm going to do this again and have John and Jonathan on for my Series B. Okay.
Great.